Welcome, Mindsetters, Accounting Buffins. It is your chance now, doing grade 12. My name is Abram, and I'm with Mahesh. How are you, Mahesh?
I'm well, Abram, and you?
I'm supercharged. You know, it's accounting. I love accounting.
I know you love
told
accounting.
You.
Yes, you did.
So
last week.
we're gonna learn a lot today.
We are. We're going to have some fun, too.
I'm up and ready. What are we doing today?
Today, we're going to look at analyzing financial statements, and we're going to focus a lot on ratio analysis and commenting on ratios.
Nice one. I'm so looking forward.
Brilliant.
Before you just go, let me pump you up with a motivation.
Please do.
There's a great
it.
quote that says, only accountants can save our world. And I believe so because we deal with numbers. Imagine if our state will lose all the taxes, all the numbers, our economy will just drop. So accountants, we need them in our world.
Yes, we do.
Go do your job.
Brilliant.
Right. Mindsetters, accountants, and you, grade 12s, this is your chance now. Chat with us and be part of our show. It's simple. Go over Facebook. Our Facebook page is facebook.com/LearnExtra. You can also tweet me. Follow us on Twitter @LearnExtra. And lastly, you can also get the notes of today's show on learnextra.co.za/live. And one last thing, Mindsetters, if you'd like to be our Mindsetter of the Month, log on to our website and find out how you can be one of our Mindsetter of the Month. We'll tell you more as the show proceeds. But for now, Mahesh, it's time for us to learn.
Okay. Right. Thanks, AB. Guys, in today's lesson, we're focusing on analyzing financial statements. And by doing this, we automatically going to turn our attention to ratios. The ratios that we're going to be looking at, guys, those that affect liquidity, solvency, risk, and return. Now, when we're doing ratio analysis, we obviously need to focus on certain calculations and thereafter the relevant comments on these calculations. Right, let's move on. Okay, guys, we're going to look at firstly liquidity. Now, what do we mean by the term liquidity? This is very, very important, and it's a very common exam question. Liquidity is simply the ability, let's get this pen out again. Liquidity is the ability of the company to pay its short-term debts. Now, what do we mean by short-term debts, guys? Here we're talking about all their current liabilities. So can the business pay their current debt, their current liability, such as their creditors, maybe they have a bank overdraft, maybe a short-term loan, their current liability. Now, the specific ratios that affect liquidity are your current ratio, then we have the asset test ratio, your debtors collection period. This ratio looks at how long your debtors are taking to pay their debts. Your creditors payment period. Okay. Then we have our stock turnover rate. Right, and then the last one, which you guys cannot see at the moment, and I'm trying to figure out, oh, there we go. Let's just go down a bit there. The number of days stock on hand. So your liquidity ratios, guys, remember, in an exam question, you must be able to identify your liquidity ratios. If you ask to comment only on liquidity, these are your 6 very, very important liquidity ratios. Right, let's now look at the next category. The next category is the category or the term solvency. Now, again, what do we mean by solvency? And again, guys, just like liquidity, this is a common exam question. Solvency is simply the ability to pay off total liabilities or total debts after selling total assets. In other words, whereas liquidity was looking at simply whether the business can pay short-term debts, solvency focuses on total debts. Now, the common mistake, AB, that we find in the exams, and I want you to remind your mindsetters about this, our mindsetters about this, is the students make a mistake. When we ask them, what is solvency? They say, okay, liquidity is the ability to pay current debt, So solvency is the ability to pay long-term debt. That's a common mistake that they make. But remember, solvency is total. Total means, can I pay current and plus my long-term liabilities as well? Current plus your non-current liability. Right, under your solvency ratio, guys, there's only one ratio, and here we're comparing total assets is to total liabilities. Let's move on. The next set of ratios that I'm going to explain, also absolutely important, deals with risk. In this category, there are two very important ratios, and here we're going to look at borrowing capital, so taking out a loan, versus using own capital. Own capital, remember, when you deal with companies, it's obviously obtained by selling of shares. So here, risk, looking at whether the company should borrow additional capital or should the company use their own capital. All right, let's pay attention to, or let's go through the two ratios involving risk. Let's talk about them in a bit more detail. The first ratio is your debt equity ratio. Debt referring specifically to your non-current liability. Equity referring to your shareholders' equity. Okay, another way of looking at it, debt refers to your borrowed capital. Equity refers to your own capital. So this ratio looks at borrowed capital against own capital. The actual calculation involves the following. So we're simply going to take our non-current liabilities, which we're going to obtain from the balance sheet, and we're going to compare this against shareholders' equity. Now, grade 12's very, very important. We've done a balance sheet. Shareholders' equity, please remember, refers to three components: ordinary share capital plus share premium plus retained income. Okay, you guys got that? Absolutely important, because sometimes in the exam, they might not give you shareholders' equity, which means you need to remember, I need to add these three amounts in order for me to get my shareholders' equity. Now, also, when we're looking at this ratio, another term that you may have already come across at school is the concept of gearing. AB, when we talk about gearing, we're not talking about cars.
Yeah, top gearing.
No, definitely not. But here, in accounting, when we refer to gearing, we're simply establishing, is the business low geared? Low geared means low risk. Or is the business high geared? High geared would be high risk. Now remember, a company would strive to be low risk at all times. Yes, there are certain exceptions, but that's what a company would strive to be. You rather have your own capital instead of borrowing capital, because you have to pay interest.
Where do we draw those exceptions?
Okay, the exceptions, it's a bit tricky. Most of your textbooks would say low geared is anything that is less than 1:1. So for example, 0,5:1 would be considered to be low geared, because for every 1 rand of own capital, you have 50 cents of borrowed capital. Okay? High geared, on the other hand, would be anything more than 1:1. Where if it's more than 1:1, let's say, for example, my own capital is 1 rand compared to my borrowed capital, which is 1 rand 10 cents. Okay, but this gets a bit tricky, because sometimes, even though you may be low geared, by taking out an additional loan, you can become high geared.
Nice.
And that's what the question often tests.
Interesting.
Okay, right, let's move on. Okay, still with the category of risk, guys, the next ratio that we're looking at is your return on total capital employed. Now let's look at firstly the calculation itself. Here I'm going to need my net profit before tax, which I get from my income statement. Remember, here you are analyzing financial statements. So you're going to get your information from your income statement or from your balance sheet or from your cash flow statement at times. So net profit before tax is my income statement. To this, I'm then going to add interest expense, which I get from, let's just fix that, interest expense, which I get from also my income statement. And I'm then going to divide this by average capital employed. Now, guys, the word average, and I know you've come across this before in grade 11 and grade 10, average is simply the half of current year plus the previous year. Now, which amounts are we actually looking for in this ratio? Capital employed. The word capital employed refers to your non-current liability plus shareholders' equity. In other words, total capital that you have employed for the business itself would be what you've borrowed as well as what the shareholders have contributed to the business. Okay, now when it comes to this ratio, guys, very quickly, very, very important. Return means what do I get out of this investment? So if, for example, you are getting a return of, let's assume, 20%, we then need to compare this return to the interest that we are paying on the loan. So if, for example, the interest is 12%, this return is considered to be good for the business because the return is much higher than the interest that is being paid. But if it was the other way around, so if, for example, our return was only 12%, but let's assume our interest, and I know interest cannot be 20%, let's hope that never happens, but let's assume the interest is 20%, then immediately as a comment, you know that my interest that I'm paying on my loan is 20%, I'm only getting out 12%, so this loan is actually not worth it. It's not worth me taking out this loan. I'm paying far too much interest in comparison to my return. Okay, right, let's look at the next category, guys. Very, very important, the category of returns. Here we're looking at 5 ratios in total. Shareholders, remember, when we talk about returns, returns affect your shareholders. Shareholders are your investors in the company. It also impacts on your potential shareholders, people who want to invest in your company. So they are very interested in these 5 ratios. Shareholders want these ratios to be as high as possible. So when you are comparing current year to previous year, you need to remember that. This ratio needs to be as high as possible. The higher the ratio, the more they want to invest in the company, the more they want to buy in the company. Right, let's just go down there a bit. Are we down? Yeah, we are. Let's extend the page. You may have to sometimes distinguish between a long-term shareholder as well as a short-term shareholder. Now, what do we mean by this? Long-term shareholder, I want to keep my investment for as long as possible, longer than a year. I want my investment to grow. A short-term shareholder, on the other hand, I want to keep my investment for maybe 3 months, 4 months, and I want to sell this investment the moment I see there's a possibility of me making a profit if I sell my shares. In other words, AB, it's like making a quick buck. So those are your short-term shareholders. Long-term shareholders, they, on the other hand, they want the company to really grow. They want the company to retain funds so that at a later stage, they will obviously reap the rewards of waiting.
Is that a smart move, though?
It can be. Yes, it can. And it can be no as well. It is risky. Buying shares is risky. You've got to know your share market extremely well. Okay. Right. Before we look at the actual ratios concerning return, are there any questions? Or should we take a quick break?
So far, let's just take a quick break.
Okay.
As you're about to take that quick break, Steve Jobs once said, my favorite things in life don't cost anything, but it's really clear that most precious resources that one could ever have, it is time.
Oh,
So
brilliant.
time is very much precious, guys, out
Especially
of everything.
accounting.
Especially in accounting, it's beyond the numbers, it's beyond everything else. So guys, let's keep up the time. See you after the break.
Good.
Right, welcome back, mindsetters and all you accounting buffins, grade 12s. Now, let me just take some comments, Mahesh, and then we just continue over our Facebook page.
Okay, brilliant.
Remember, mindsetters, if you don't know our Facebook page, it is facebook.com/learnextra. We're still learning a lot. And holla to everybody that is just tuning in, saying, AP, we are loving the show, like Munu. Chino saying, I'm also enjoying the show. There's a question from Mpo Joy, but she says first, Hala, nice teacher we're having. May I ask if it's if 1-to-1, is it a low risk or high risk?
It's high risk. 1:1. I'm sure they're talking about the debt equity ratio.
Yes.
That would be high risk.
All right,
Okay.
Mpo, it is high risk. We'll take more of your questions as you bring them along on the Facebook page. Mahesh, let's continue.
Okay. Right, guys, let's carry on. Before the break, we were talking about returns, the category of returns, and this is where your shareholders are obviously very interested in these set of ratios. Let's look at the first one. The first one, absolutely important, guys, for your exam, earnings per share. And remember, in the exam, this abbreviation is allowed. You can call earnings per share EPS. So in order to calculate earnings per share, I'm taking my net profit after tax, guys, not before tax, after tax, which I get from my income statement. I then divide this by number of shares issued. Okay, now remember when we did a balance sheet, we came across this when we calculate dividends. Number of shares issued, I want to write this down for you guys, is simply the ordinary share capital. So the total that you get from the balance sheet, ordinary share capital, divide this by your par value. And that gives you the number of shares issued. If the answer needs to be in cents, you're then going to multiply this by 100 to get the answer into cents, or you can leave your answer in rands as well. Right, let's look at some of the comments that can be made about this ratio. Again, guys, the higher this ratio, the better it is for your shareholders, the happier your shareholders. It also indicates the maximum that shareholders can earn per share. Now remember, guys, shareholders, obviously, from your earnings per share, you will then pay out dividends. Okay. So earnings per share indicates the max that shareholders can earn per share. Sometimes, and this happens very often, guys, you may be asked to compare this to DPS. Now, we're going to come across DPS, dividends per share, and again, very, very important for your exams. Okay, right, next return ratio is your dividends per share, what I've just mentioned, DPS. And in order to calculate my DPS, I'm taking ordinary share dividends, which I get from my retained income note, or if I'm not given the note, guys, please remember, ordinary share dividends is a sum of interim plus final. And that gives me my ordinary share dividends. If you're not given the retained income note, divide again by the number of shares issued, and again, if you want your answer in cents, you're going to multiply by 100. Right, like I mentioned for the last ratio, again, guys, the higher the ratio, the better. You may be asked to discuss together with EPS, earnings per share, and here, there is a possibility that you may be asked to distinguish between your long-term and your short-term investors. In other words, remember, dividends per share is your shareholders' share of the profit. Now, you're probably thinking the obviously, the higher the profit, the more dividends a company can pay out. But that is not necessarily correct, because let's say, for example, we have a net profit after tax of 100,000, but we could decide, when I say we, I'm talking about the company, the directors could decide that from that 100,000, they want to retain 60,000. So 60,000 becomes the retained profits, and they want to pay out 40,000. Okay, so in this situation, the company could have paid a very high dividend, but they want to retain profits. Now, why is it important to retain profits? Okay, AB, why is it important for you? You obviously earn a wage or a salary, for you not to spend that entire amount. Why is it important for you to retain, to save?
Because at times there could come unexpected expenses,
Exactly.
so you need to be prepared.
You need
at
to be
all times.
prepared for the future.
Yes.
And you probably, at a later stage, you want to drive a better car, you want to live in a more fancy house, you want to obviously expand.
So true. So
similar
that's why
with
you
a
have to
business, you
to
want to
save.
retain profits, exactly, so that the business can expand. So this is where the long-term and short-term investors, your comments would vary at times. Right, the next concept, guys, is your net asset value per share. And here, the word net asset value means what is the actual worth of your shares? What do your shares, what's the actual worth? If I want to sell my shares, at what price should I sell my shares? Ordinary shareholders' equity, which we get from our balance sheet. We're going to divide this by, again, number of shares issued, times it by 100 cents if you want your answer to be in cents. Like I mentioned, it indicates the worth of your shares. The higher the net asset value, the happier your shareholders, because it means they can sell their shares at that price. It also needs to be compared to the par value, the original price of your shares, as well as to the JSE. The JSE, guys, refers to your market price. Okay. Right, this ratio indicates to a shareholder, remember, because shareholders are interested in your return ratios, mainly your shareholders, whether or not to sell his or her shares, and also at what price. Okay, that's very important. Net asset value, at what price can I sell my shares? Okay, right, and then guys, the very last ratio that we are discussing before we look at an actual example is your return on shareholders' equity. Here, we're going to take net income after tax, which I obviously get from my income statement. Again, divided by, this time, average. Average, remember, is half of current year plus the previous year. And which figures are we talking about? Shareholders' equity. Shareholders' equity is what you get from your balance sheet. So I take my current year plus previous year, divide by 2, and that gives me my average shareholders' equity. Again, I'm sure you guys are tired of hearing this now, but the higher the percentage, the better. And this ratio is often compared to the current interest rate offered by banks or alternate investments. Alternate investments. So for example, if I get a return of, let's say, 25%, and if I compare this to the rates that are being offered by the banks, I'm not sure, guys, so don't quote me on this, let's say 9%, then it was worth me taking the risk because my return is much higher than what the banks would offer. Okay, right, I think we've done enough of explaining. It's time now to do an example. What do you think, AB?
Let's get to it.
Okay, brilliant. Right, AB, I don't know whether you want to mention this quickly, or maybe I should mention it quickly to the mindsetters, that on the page itself, the notes that have been uploaded, we've got a table for them where all these ratios have been summarized. And there's also the ratios that I haven't discussed. I haven't discussed profitability.
Yes.
So all of these ratios are in a table. And what I would suggest for the mindsetters to do is get a copy of this, put it up on your bedroom wall. Take out Justin Bieber, put up this on your bedroom wall, and go through these ratios, guys.
Or next to him. Otherwise,
or next to him, maybe that would be better.
because you'll be inspired and also learning at the same time. But I do have the link on the page.
Okay,
and also
brilliant.
mindsetters, you can download them straight from our website, learnextra.co.za/live.
Okay, right, we're ready to start with the
Yes,
question.
yes.
Brilliant. Guys, the question that I'm going to do today was taken from November 2009, end of the year exam, and it was question 5. So even if I don't finish, you know that's a question that I was looking at, November 2005. The information given was, sorry, let's start again. The information given below was extracted from the financial statements of Manchester Limited, distributors of exquisite perfumes. And then we've got our required, but before we look at the required, I think let's go through the information first, because it's on a separate slide. So this is the information that has been given to us. We've got an extract of the income statement given to us, guys. Then there is the balance sheet. And looking at this balance sheet, it's a completed balance sheet that is given to us. Okay, and then on the next page, we then have some additional information as well. Okay, so we've got some additional information, right, all the way down through. Looking at the additional information, I noticed they've given me earnings per share. They've given me total dividends. So this is my dividends per share that they've also given me. They've broken it down into interim and final. And then at the bottom, they've got, you are provided with certain or the following financial indicators: percentage return on shareholders' equity, return on capital employed, and then my net asset value per share. Okay, right, and then there's a last bit of information here, which I'm going to read. The price of the shares on the Johannesburg Security Exchange, or the JSE, has fluctuated meaning it's obviously going up and down, between 680 cents and 780 cents over the past year. Okay, so we've looked at the information, and before I go to the actual question, guys, something absolutely important, and I know a lot of you watch Ashraf and he's mentioned this, is please, very, very important, 2009, 2008. 2009 is my current year. 2008 would be my previous year. Absolutely important that you don't mix the two. Right, let's now look at our questions, and we'll obviously come back to that information. The first question wants me to calculate the following for 2009. So in other words, for the current year. Okay, very important that you read the question, you could read the entire question. The first is your current ratio. Now, current ratio, guys, I know you remember this. You've been doing this from grade 10. Current ratio, I'm looking at current assets is to current liability. And where am I going to get this info from? Correct, from the balance sheet. So let's go to the balance sheet. And remember, we're looking for current. So my current assets, okay, let's get the pen out. There's my current assets. And I know I'm going to need my current liabilities. At the bottom, there is my current liabilities. So no calculation, taking it from the balance sheet. So one more time, current assets, current liabilities. So let's fill that in. So my current assets was an amount of 320,000, and your current liabilities was a total of 3 90, 885. Okay. Right, when you're doing ratios, remember I want the right-hand side to equal to 1, so I'm going to divide by 390, 885. Whatever I do on the right-hand side, I must do on the left-hand side, so divide by 390, 885. And here, obviously, we're going to get a ratio of 1. Let's get the calculator out. Clear that. Okay, so we get taking 320,000 and we are dividing this by 390, 885 to get a ratio of 0,8. Remember guys, round off to the first decimal, 0,8 is to 1. So let's fill that in. 0,8 is to 1. Okay. Now, the question doesn't want you to comment, only wants you to calculate. But if you had to comment, guys, for every 1 rand of current liability I owe, I only have 80 cents of assets to pay, current assets. Okay. AB, should we take another break?
I think we should do it.
Okay, brilliant.
Right. As we're doing that mindset, please make sure that you download your notes and stick them next to your wall and read them every day. Those are the greatest tips we've heard from Mahesh and also Lindsay saying that. Let me suggest that to all of you mindsetters. So as you're about to take a break, remember that returns are only something that you can do and be thankful for. You know, reward yourself. So see you after the break. Grade 12s, welcome back. You accounting buffins tuning in right now on this wonderful show, live show with me, Abram and Mahesh. Now, it's time for us to take some questions.
Okay.
Are you ready?
It. Yep, I
right,
am.
the first one, it's from Ngeba Noktula Dube. It says, the number of shares issued, do I add to the ones issued during the year if it's not recorded on the trial balance?
Yes. Yes, you have to, because remember, when we talk about number of shares issued, it is at the end of the financial year. So if there were shares issued during the year and it hasn't been included in that, like she said, trial balance, then you've got to do that in your calculation.
Okay.
Okay.
All right, last one for now. Lihlonano Nolintle Matlo says, thanks for the nice show, really enjoying it. What is the difference between interim and final dividends?
Okay. Interim dividends is dividends that are paid out to shareholders during the year. A final dividend is declared at the end of the year. So an interim dividend during the year, I give my shareholders a bit of the profit, and then at the end of the year, we declare a final dividend.
All right.
Okay.
Before we continue, I just want to ask you a question as an accountant. There's this question that we had over the social media, which says, if there comes a time for you to choose between money and trust as an accountant, what do you choose?
Between mind and trust?
Money and trust.
Money and trust. Oh.
Okay, think about that. I'll ask the mindsetters, what do they think?
Yeah. I think that's easy. No, definitely trust.
You
definitely
choose trust.
Yeah,
all right.
Definitely. Okay, even for an accounting teacher. Okay, can we carry on, AB?
Yes.
Okay, brilliant. Right, guys, the next ratio, remember we're busy with November 2009, sorry. The next one is your asset test ratio. Just change that, asset test ratio. And the ratio itself, I'm going to take my current assets minus stock or minus inventory is to or compared to my current liability. Now already guys, from the information or from the previous question, I know my current liability is that amount at the top, which is 390,885. My current assets, which was 320,000, I've got to now pick up my inventory amount from the balance sheet, so let's do that. Okay, so let's get rid of the calculator. Right, my inventory, that's what we're looking for, so inventory under current assets. So there's my inventory, and my inventory, quite a large amount, okay, 251,250. So let's take that. Okay, wrong slide. There we go. So we're going to subtract that inventory amount that I've just read out, 251, 250. Okay, let's make the writing a bit smaller there. Right, let's now work out this ratio. So remember, this calculation needs to be done first. So let's get the calculator out again. Okay, so I'm taking 320,000, which is my current assets, and I'm subtracting my inventory 251, 250, which is, oh, what did I do here? Let's do that one more time. 320,000, and then minus 251, 250. Okay, that looks better. 68,750. So 68,750. Remember, guys, the word asset test ratio, without your stock, can you still pay your current liabilities? Compared to 390,885. So again, guys, we're going to divide by 390,885. Whatever we do on the left-hand side, we do on the opposite or the right-hand side as well. So 390,885. And here I'm getting 1. Let's get the calculator out again. Okay, so I've got that figure already, divided by 390,885, and I'm getting a ratio of 0.17, or if we round off, 0.2 is to 1. Okay, so 0.2 is to 1. So immediately, again, you don't have to comment, but if we look at, if we did have to comment, can you see this business is obviously struggling with liquidity? They're struggling to pay their short-term debt. How do we know that? Because for every 1 rand of debt that is owed, they only have 20 cents without their stock in order to pay this debt. So clear indication of liquidity problems. Right, the next calculation, guys, are your net asset value per share. So let's look at the formula. Ordinary shareholders' equity divided by number of shares issued. Okay, let's just bring that up a bit. Right, ordinary shareholders' equity, I'm going to pick that from my balance sheet. So if I go to my balance sheet, I'm looking for equity. Okay, so there's my equity. My ordinary shareholders' equity, remember, guys, is a sum of these 3 items. So ordinary share capital, share premium, retained income. So if I add up these amounts, the total at the top is my ordinary shareholders' equity, 3,120,000. So let's take that through, 3,120,000. I'm now going to divide this by number of shares issued. Now remember, I mentioned this. How do I get number of shares issued? So in order to get number of shares issued, I'm going to take my ordinary share capital. I'm going to then divide this by my par value to see the actual number of shares issued. And I'm just going to write here, this is always at the end of the financial year. So let's go back to our balance sheet. My ordinary share capital is given to me. Let's just quickly get a different color pen. So that's my ordinary share capital, and the amount 2,085,000. And I also need par value, which is given to me as well. Par value is 5 rand. So by taking my ordinary share capital divided by 5 rand, or divided by 5 rand, I'm going to get the number of shares issued. So let's do that. Okay, so we've got 2,085,000. I'm going to divide this by 5 rand to get number of shares that are issued, 417,000. So let's take that through. Okay, 417,000. And remember, guys, I think I want my answer in cents, so I'm going to multiply by 100 to get my answer in cents. And again, the calculator out. we are taking 312, okay, and watch those zeros, quite a number of zeros, divided by number of shares, and my net asset value is, if I'm going to multiply by 100, okay, is 748.2 cents. So let's write that down, is 748.2 cents, or if you wanted to show your answer in rands, 7 rand 48 cents. Okay, right, how are we doing? Are there any questions?
So far, we're doing well. Mindsetters enjoying the show.
Okay, brilliant.
And other mindsetters helping one another too.
Oh, that's so fantastic.
Yeah.
Huh? That's absolutely fantastic. Right, guys, let's move on to the next ratio, your debt equity ratio. And remember, I spoke about this, guys. Sometimes they call this the gearing ratio. Your debt equity ratio, we're obviously going to be looking at your non-current liability compared to your ordinary shareholders' equity. Debt equity. Remember, don't swap them around. Okay, ordinary shareholders' equity, we've already used that figure, and that was the figure above, the 3,120,000. That was your total shareholders' equity. Your non-current liabilities. Let's go to that balance sheet and find our non-current liabilities. There we go. There's our non-current liabilities, and it's sitting at 300,000. So not bad compared to our, if I compare that to our equity, but let's do the ratio itself, 300,000. And again, guys, whenever you're doing ratio analysis, remember, you want the right-hand side to equal to 1. So I'm going to obviously then divide again by 312,000. And then whatever I do on the right-hand side, I obviously do on the left-hand side as well, 3,120,000. And we're now ready to work out what is that debt equity ratio. Okay, calculators out. Okay, 300,000. Okay, divided by 312. And again, lots of zeros. And that gives me 0.09, or if I round off, 0.1. Okay. Right. Abraham, quick question for you.
Yes.
Okay, look at this ratio. I've got a ratio of, this is my equity, my own capital is 1 rand, and my borrowed capital is 10 cents. So am I low geared or high geared?
You're low geared.
Oh, low geared, fantastic. Okay, now I definitely need to bring chocolates for you next week.
Thank you.
Okay.
Thank you in advance.
Right. So we definitely, guys, we are low geared. Okay. Right, let's move on now. I think we've done lots and lots of calculations, and we're now getting to some kind of analysis of these calculations that we've done. So I want you guys to listen very closely to the next set of questions. Explain why, let's get the pen out, explain why the directors decided to reduce the long-term loan significantly during the current financial year. In your opinion, was this a wise decision? In other words, they want you to answer with a yes or a no. Explain quoting evidence, in other words, figures or financial indicators from the question itself. Okay, 6 marks, so there's obviously quite a bit to do in this actual question. Let's look at the first question. Explain why the directors decided to reduce the long-term loan during the current financial year. And for that, we need to go to our balance sheet. So my loan last year, remember 2008 was the previous year. So if I look, my long-term liability for the previous financial year was 1,525,000, and it has obviously dropped quite a lot in this financial year, 300,000, which clearly is an indication that you've paid towards the loan. Now, the question is asking you, why do you think the directors decided to reduce the long-term loan? Now, if we, leaving our balance sheet on the screen, if we compare our non-current liability for 2008 to our equity, there's my equity and there's my non-current liability. Clearly, guys, you can see your equity was less than your loan, your long-term liability, which means that the business had to have been high geared. Okay, let's quickly do a calculation to show you that the business was high geared, very similar to the previous calculation. So I'm gonna, what have I done? Let's find this quickly. Okay, get the calculator out. Just remove that. Okay, so if we look at last year's debt equity ratio, if I take my loan amount, 1,525,000, okay, and if I divide this by my equity, 1,443,000, okay, right. Clearly, I'm going to see that the business was high geared. So the actual ratio was 1,1:1 in your previous year. So in the previous year, this ratio was 1,1:1. So obviously, the directors saw this. The business was at high risk with such a high gearing ratio, and they decided to pay off a certain percentage of the loan. There's something else, guys, on the next page. Let's find this. And here I'm going to my financial indicators. If you look at your return on capital employed, now remember, I spoke about risk. Return on capital employed is one of those ratios that will indicate to you whether the business is actually receiving a greater return than the percentage of interest that they're paying. So for 2008, okay, this return was 10%, and let's go back to the information, to the balance sheet, okay, and let's see what the interest on loan was. The interest on loan, there we go, was 15%. So clearly, the return is only 10%, that's the return, and the interest is much higher than the return, 15%. It's not worth borrowing this capital, not worth borrowing this loan. So the first part of the question, guys, okay, explain why the directors decided to reduce the long-term loan. Your answer would be the business was high geared. Okay, I'm just going to write it in point form, guys. The business was high geared in the previous year, which was 2008. And also, I can mention the return on total capital employed was 10%, and the interest rate, that's what I'm talking about, guys, was 15%. In other words, you need to tell the examiner that the 15% was much higher than the return, which was only 10%. So the first part of the question is answered. Let's now look at the second question. In your opinion, was this a wise decision? Okay, now clearly, guys, yes, it was a wise decision. We are then asked to quote relevant or figures, financial indicators from the question itself, and you don't have to go very far. If we go to the previous question, just find that quickly. Okay, the previous question, let's look at what happened to our debt equity ratio. Our debt equity ratio, let's just go down a bit. There's our debt equity ratio. It's obviously now low geared. So it was a wise decision. Okay. AB, do you think we can do one more question, or?
I have some questions that
okay, let's take that then.
Yes. One is from Prudence, which says, how do you get the inventory amount if it's not given?
If the inventory amount is not given. Okay, sweetie, if the inventory amount is not given, then you probably will be given the note for inventory itself, and that's where you can pick up the inventory amount. Sometimes they could throw in a question with weighted average, the FIFO method stock valuation as a section that could help you to calculate your inventory as well.
All right.
Okay, you never know.
We seem to be having a lot of questions also
Okay.
concerning the issuing of the dividends.
Yeah.
Katlo says, oh well, do we have to do the interim dividends, and why not just the final
Okay,
final
Katlego.
dividends?
Okay, I'm not
Do
quite
we have
sure.
to do the interim dividends?
Okay, when she says do, I'm not quite sure what she's talking about. But there, if I need ordinary share dividends, it's a sum of interim plus final.
Okay.
I think a question might be, does the company have to pay an interim dividend?
Yes,
And
yes.
the answer there would be not necessarily. If the company is not making a profit, then they're not going to pay out dividends during the year. They might just declare a final dividend.
All right.
Okay.
And other than that, it's just great comments, enjoying the show.
Oh, brilliant.
But because of time, I think we'll just have to take some of the comments from the mindsetters.
Okay.
Is it cool with you?
That's fine. That's absolutely fine.
Right, as mindsetters, I told you that you can be one of our mindsetter of the month. For you to be one of them, it's simple. Go over our website and check out what does it take for you to be a mindsetter. Be on the page, like our page, and let's learn more. But otherwise, Mahesh, thank you very much for this great session. We'll
Okay.
see you next week
Yes, you
with
will.
my chocolate.
With your chocolate.
All right.
Definitely.
Thank
On
you
air.
very much.
Okay.
Mindsetters, accounting buffins, thank you very much. Learn more, learn extra. Nothing is easy in life, so take it slow, but learn more, learn extra. We love you.